investors. The Federal Reserve has increased its interest rates further. The contingent from the regional banks seems to be well contained. But there is another crash happening right before your eyes. And it is this continuous effort for us at GCP Global to warn you about for real estate investment trust investors. Well, what is happening? Now look at this chart, ladies and gentlemen. A year ago, we warned on the listing of Digital Core Reit. We look at essentially its prospectus, almost 600 pages, and we told you that essentially for investors, this is going to be an aggressive REIT, because they are looking to offload close to 5 billion of assets into the REIT, Digital Core Reit at IPO. And then essentially, the key thing is that it is not coming in at the right time, because just when interest rates was about to increase, and interest rates started to increase last year, the IPO of Digital Core Reit was just the end of the previous year, that means end of 2021. And they're looking to acquire 5 billion, aggressive in any nature. So for conservative investors like us, as well as the investors that attend our classes, basically conservative, old money, ultra rich investors, family offices, we have avoided the stock. Essentially, one of the other key corporate governance issue that we have on the REIT is the fact that it is owned by a sponsor, that is Digital Reit, which is a REIT itself, a real estate investment trust listed in the United States. And they essentially had gone on an acquisition brink in the year 2015 when they acquired European assets. And it is not surprising that some of these European assets would be offloaded to Digital Core Reit if these REITs are essentially, or if these assets are of not a certain standard. Now, the other thing that we cautioned on the corporate governance front was the fact that where do you draw the line between having the assets to be pumped into Digital Core Reit, Digital Reit? And essentially what happened in the last 1 year, look at how the share price has crashed. Now, this is the chart that shows that on a 6 months basis, this stock, Digital Core Reit, has crashed 41.5%, down to 42 cents last year. On a 1 year basis, the stock has crashed even more, down 62%. Now compare this to another REIT, one of the REIT that we have warned and told you about in our previous videos, that after meeting the REIT, essentially there's nothing wrong with the REITs, and this is actually none other than Capital DC Reit. Essentially, in the last 6 months compared to, say, Digital Core Reit, you notice that the Capital Reit has actually inched up or even moved up, despite a lackadaisical REIT market, up by 13%, one of the best performers. So you may be wondering, same sector, that is data center, why is Digital Core crashing even further? Down 61% or 62% for the full year, down 40% on 6-year basis compared to its competitor Capital DC, which is actually up 13%. Look no further, ladies and gentlemen, because if you follow us in our video, you notice that this is a picture of a lunch that we had with Miss Antia Lee, the CEO of Capital DC. Yes, she is the lovely lady in white. Remember after the lunch, as in our previous video, just a couple of months ago, we told there's nothing wrong with Capital DC, even though the share price has actually fallen from $3 to 180. In fact, at 180, we told you that it was an opportune time to be buying Capital DC. And true enough, for those who have attended our GCP Global investment classes, they have benefited substantially and profitability from this REIT. Now let's go back to what's happening in Digital Core and why we continue to warn about this REIT. Just last year, you noticed that one of their 6 so-called, good, or what they term, as good tenants, SunGard actually went on. And what happened? In a statement, this is a statement from Digital Core, and let me just read it out to you. The manager has recently executed a cash flow support agreement with the sponsor, and the sponsor has agreed to make Digital Core Reit whole for any cash flow shortfall related to the customer bankruptcy. In this case, this customer is SunGard. Guess what? The bankruptcy coverage is only until the end of this year. But, ladies and gentlemen, what we want in investment classes is that don't look just at the headlines or the first paragraph. Look at the second paragraph, because the second paragraph is the killer for Digital Core Reit investors. That is, in the second paragraph, it says that Digital Core Reit has agreed to repay any cash flow support. So guess what? The cash flow support is not free, to the sponsor. Okay, and it says that from 1st January 2024 right through 2028. So there could be a possibility where DPU will be impinged materially if any of this support that Digital Reit supposedly give the Digital Core has to be repaid by Digital Core during that period. So what support is there, ladies and gentlemen? It is just a deferment of the DPU, for Digital Core Reit. So it was really not a great support in our view at that time. And true enough, just 8 months ago, we warned in our latest video the crash of Digital Core Reit. And true enough, what happens? In 6 months, the share price of Digital Core has crashed 42%. Now, just in our recent class, that was actually last month, we warned further on Digital Core, despite the fact that the share price has already crashed through 50 cents. And one of the things that we have highlighted to students who came for our February class was one of the other 6 customers. Can you imagine? The first good customer, SunGard, bankrupt. Second customer, Systema, in this case, or rather, Systerac technology. Now, we highlighted in this graph, you can see that the share price of Systerac, has crashed from $15 down to $1.39, as we have mentioned in our classes that, in just 1 year. As of course, Systerac's technology is listed in US. And you notice that essentially, if we look at Systerac's latest set of results, which was released just a fortnight ago, now in the highlighted region, the net loss was 210 million posted in one quarter. Oh my goodness. Of course, they did say that the net loss of 210 million was caused by goodwill impairment cost of 153 million. Well, if you actually take the goodwill away from the net loss of the 210 million, operationally, Systerac actually registered an operating loss of close to 60 million. So, ladies and gentlemen, look no further. If you think you have a going concern problem with Systerac's technologies, because that was our problem with capital DC, but because the Digital Core, did not even affirm, or warn the market about this for 2 months, until just recently when they were probed, in the press, and essentially, but in February, we already picked this up. Can you imagine? Because if you read further on Systerac's balance sheet, you can see there are few items given there. Okay, it is, on surface, if you look at Systera, the total asset is 3 billion, but 3 billion comprises $500 million of goodwill and intangible assets of 427 million. So what it's trying to say is that actually the total assets 3 billion, 1/3 of that is actually intangible and goodwill. Wow, that is a key warning point for us when presented in our February class. Then look further. The liabilities will kill you, will kill the REIT. One is that the current portion of the operating lease liability was 35 million. This is in S-REIT's latest set of results. The current portion of its long-term debt is 97. The operating lease liabilities is 272 million. The long-term debt is 854 million. And the finance leases and other financing obligations for which they are bound contractually is 1.1 billion. Then in our computation, which we presented in our class, you can see that if you add all these liabilities, right, less the cash of 65.1 million, you will see that S-REITs, the total net liability is actually 2.27 billion. And you less off the tangible assets. That means you can't possibly count the goodwill as well as intangible assets of 1.6 billion. You actually have a balance sheet for S-REITs with net tangible assets of minus, yes, ladies and gentlemen, minus 632.3 million. So essentially, you have a case where S-REITs have a net current liability of 632 million. Is it a going concern problem? You decide, okay? But it constitutes 23% of capital DC rental, okay? So that is the risk, and that is the crash that's happening right before your eyes, okay? So as you can see, ladies and gentlemen, when we talk in our previous videos, we have warned on this, and this has continued to get worse, okay? It is actually quite a wonder why SGX did not query them about one of its key customers. In this case, now 2 out of their 6 major customers have gotten it. So once again, ladies and gentlemen, in real estate investment trust, as we have always warned in our 34 years of teaching in GCP Global quarterly investment classes, a REIT is as good as the assets that is owned, and a REIT is as good as the sponsor that they have. Any ambiguity must always be solved at the IPO level. If not, avoid the stock. You get into trouble with the stock, essentially quickly sell off, and that's what we actually advise or guide in our investment classes. So once again, hope you enjoyed this quick video. Give us a like, subscribe to our videos, and we'd like to join us and have an invigorating analysis into the holdings that you have in your REITs portfolio. Join us for our next class on the 27th of May, 2023. Be protected so that you can let compounding work for your REITs portfolio to make you the millions that you have. Remember, for REIT investors, you should be risk adverse. But the REITs that you have invested, are they actually risk adverse in the very first place? That's what Capital Digital DC Core Reit, as we have warned about all these years, have shown. Once again, adios until next week.